Okay, I guess it's time to go ahead and get started. So good morning, everybody. We have an exam starting on Thursday, right? Okay, I was expecting more people to be here today, but okay. In fact, the TAs told me that yesterday up in the office they weren't very busy at all, which is very surprising to me. So maybe everything is so absolutely crystal clear that you guys are on top of it, which I hope is the case, and we'll see some good grades on the exam. So, all right, let's see. I have a few announcements this morning. I feel like I've been cheating you on announcements lately. Tomorrow is Veterans Day, of which I am one. So the school is closed tomorrow, which also means the TA office is closed tomorrow. So if you want the TAs, today is your window. Because tomorrow's Veterans Day and then the exam opens up on Thursday. So if you need the TAs, they'll be here till I think about 4 o'clock or so today. So if you want to get a hold of them, make sure you get them today. So everything on campus is closed tomorrow, not just this class, so FYI. Also, we will have our next and last math chat on Monday. So I think we scheduled it for 9 or 9:30. I don't remember, but look on web courses. Look under the announcements, and it's on there. I believe it's 9 or 9:30. If Kelly's at home watching, she'll text me in a second and clear me up. But it's on Monday. I'm going to do the same drill as before, which is I'm going to just be out at Reflection Pond. I didn't think to look at the weather forecast. But if it's like raining, then what I'll do is I'm just going to duck into the library right there. So if you come out, that's where I'll be. The last one we had was really, really, really good. So I wanted to be sure and squeeze one more in. So that'll be on Monday, and it'll be on the last one. I guess the TAs told me that a couple people had asked about moving the math chat back a week to, I guess it's the 23rd, which ordinarily I wouldn't have had a problem doing, but I've got jury duty on the 23rd. So I can't do that, which means I might not be here on the 24th either. We'll see. I'm kind of hoping that when I call in on the Friday beforehand, they'll say, "We don't need you, thank you very much," and I'll say, "Great." I haven't had jury duty in like 20 years, so I can't complain about it. And it's 2 days, a couple days before Thanksgiving, so I can't complain about it too much, but it just never seems to come at a good time. Anyhow, so that's the story with the math chat. There's also another extra credit opportunity on November 18th over in the Exchange. The president of the CFA is coming to speak. So especially if you are if you're a finance major, that's definitely something that you want to get into. I don't know if they've already, I don't know if it's booked or, I don't know what the availability is, but check that out. It's in the Exchange. The Exchange, in case you're not aware of it, is something very new. It's just a meeting area, and they're having, I don't know how frequently, I want to say once a week. It might be more than that, but it's like a speaker series. So they're having practitioners come in and speak to various groups of students, and it's located right across the courtyard from the testing lab. Okay, so you guys all know, I assume you all know where the testing lab is here. Most of you do know where the testing lab is here. If you just walk out the door and walk across the courtyard, it's right there. It's in the old, it used to be the computer lab over there. So if you know where that is now what they call the Exchange. So that's where the deal will be on the 18th. There is only one more Young Investors Club meeting. I told you guys at the beginning of the semester that when the holidays start getting close, they start scattering, and they all have finals too and all that kind of stuff. So tomorrow is Veterans Day, so they're not having a meeting tomorrow. Next week is, I believe, their last meeting of the semester. Because I believe the following week is the Wednesday right before Thanksgiving. So even if they had a meeting, they'd probably have about 4 people there. So, and I think that's it for the semester. So there you go. And like I've said a few times now, the extra credit forms are due to the TAs on the 24th. That means that they have to be in physical possession of them on the 24th. Okay. In fact, well, I better not say it, but they got to have the forms on the 24th. All right, so make sure you get those into them. Also, be reminded, I'm going to be updating the grades because there's probably like about 4 homework sets now that are not included in Canvas, and we're over the 10, so I've got to go in and set up Canvas to only count the highest 10 homework and all that kind of stuff. So I will be doing that on Tuesday, because your exams opens Thursday and closes on Monday at midnight. We have class on Tuesday, so I'll be doing all of that Tuesday afternoon. So your grade in the course right now on Canvas isn't exact. I mean, it should be pretty darn close, I would guess, within a percentage point, but it's probably not real exact because I need to go in and set up the rules for for dropping the homework in there. All right. So just a reminder, the grades will be updated on Canvas by the end of the day on Tuesday after the exam closes. Okay. But Kelly posted a grade calculator for you on in Excel. So if you can't wait till Tuesday, which I understand, if you can't wait till Tuesday, dump your grades into that, and that should get you. Tell you where you are. Okay, so all right. So what we're doing today is we're going to go through chapter 10. I'm going to save some time at the end of the class to talk about the exam a little bit. The exam will definitely cover chapters 8 and 9. We'll see how far we get in chapter 10 today. Okay, so before you ask me that, there's the answer to that question. All right. So what else was I going to say about the exam? Opens Thursday, closes Monday. He's already talking about a curve. Hey, the exam hadn't even opened up yet, and he's already talking about a curve. So, I don't remember what I was going to say, but we'll talk. Like I said, we'll talk about the exam a little bit at the end of class today. So, other than exam questions about anything else? Other than exam? Questions? Yeah. I was in the Army. Yep, I was in the Army for 3 fun-filled years. Actually, it was 6 years, but 3 of them were inactive because not many people know it. But yep, in the Army. I beg your pardon? I was in supply. I was in logistics. Yep, yeah. The fun part about it though was I spent 1.5 years in Germany, and then came back to the States. What's that? Herzog base. Herzog, then Herzogenaurach, Germany. Yes, they are. Yeah. Were you over there? In the military? Okay, in what branch? I was in the Army. Okay. Yeah, when I was there at that time, like 1/5 of the entire Army was in Germany. 20% of the entire Army was in Germany. In fact, the history, we're getting off topic, we'll get back to accounting, but the history department here at UCF interviewed me, I guess it was a couple of months ago. They were doing a big project where they're interviewing all the veterans in the area, and they did like a DVD and sent it up to the Library of Congress, and it was pretty cool. Yeah. And the funny part about that was when they were going to interview me, I didn't know what the heck to tell. I mean, I wasn't in combat or anything, so yeah, I could tell them about going down to the Green Goose and drinking or whatever. But they didn't want down in the Library of Congress. But when I started, at 20 years old, I didn't know what the heck was going on in the world. But getting ready for the interview, learning the politics of what was going on in the world at that time, very, very, very interesting. So if anybody's interested in hearing that story, we'll talk about that in the chat. Come on out to the chat and we'll talk about that. Other questions? Other questions? I'm always happy to talk about myself, but questions about the class? Yes, 1 chance to get extra credit. Other questions? Other questions? Going once? Twice? One of these days I'm going to learn how to do that auctioneer. Good way to go. All right, then let's go ahead and get started in chapter 10. One of the things that you'll see on the PowerPoints here in just a second in chapter 10 is we're talking about a couple of key, the primary part of chapter 10 is on the notes to the financial statements, on the audit process, which we talked about a little bit before earlier in the semester. But we're also talking about 2 key pieces of regulation that you should be aware of. I don't profess to be an expert on either one of them, but you should know at least the gist of it. I mean, they're actually both very complicated, especially the one that's called Dodd-Frank. Okay, I imagine it's kind of hard to not have a business conversation for any length of time without somebody mentioning the Dodd-Frank Act. And it was part of what it was aimed at was at the idea of banks that were quote unquote too big to fail. All right, and I pulled this up. This is a recent article, and I dumped it into Word just so everything would fit on there. But this is going on right now, and this is actually internationally. But they're addressing the potential problem of too big to fail over. I believe this is in the Swiss-based Financial Standards Board. So over in Switzerland. I guess England as well, somewhere over in Europe, okay, this is going on. But this is an international issue, okay, and the problem, and it came about from 2008, of course, the big stuff, yeah. Sorry, it was Dodd-Frank? Dodd-Frank. Yeah, it's named after the two senators, I believe they were, who.
Senator Barney Frank was a member of the House of Representatives.
Dodd-Frank. Okay. Yeah, Barney Frank and somebody Dodd. Chris Dodd. No. Chris Dodd. Yeah, they were the senators that really pushed this through. Very big, complex, very controversial piece of legislation, but it was aimed at a lot of things. One was this idea of banks being too big to fail. Okay, and the problem was, in fact, I think even now, like 10 banks hold 50% of all the deposits in the country. Okay, so if something happens, and especially if those banks are all interconnected through loans to each other and all that kind of stuff, then if those banks go down, then our financial system melts down. All right, and that's the problem with this so-called too big to fail. All right, and that was an issue in 2008. It's actually it was an issue for you finance majors, long-term capital management. Write that down in your notes and look it up later because it was an issue with them as well. A couple of Nobel Prize winners. That's kind of a black eye to the academic community, but I'll let you guys. That's beyond the scope of this class. But long-term capital management, finance majors. Write that down and look it up. But anyhow, so what the Dodd-Frank Act did, among many other things, one of the things it did was it gave the government the right to go in if there was and by the way, this is mostly aimed at the financial institutions, and if the financial institution becomes so big that if it failed, it would be a serious detriment to the economy, then what they can do is they can go in and break up that financial institution into smaller pieces. All right, so smaller unrelated pieces so that the economy is not threatened. Okay, that's kind of like one of the main things that Dodd-Frank did, and here's your Dodd-Frank right here. Okay, very controversial. Let's see, what else did it do? I wrote down a whole bunch of things here. Yeah, too big to fail. They can break them up. It also restricted, and I actually thought this was the way it was anyhow. I'm not an expert in the banking system, but it restricted the way that banks can invest their money. All right, and make sure you understand that the way banks make their money is, okay, let's say I'm a bank and you guys are all customers of my bank, then basically what happens is you deposit money into my bank and I pay you, let's say, 1% interest, and then I turn around and I invest that money at, let's say, 3%. So my profit is 2%. Okay, so that's, I mean, oversimplified example, but that's the way that banks make their money. All right, now in the banking regulations, which again I'm not an expert on, they are regulated as to how they can invest that money. Okay, for example, if I took your deposits and those deposits are supposed to be safe, right, and then I turn around and start speculating in commodity futures with those deposits and lose them all, then what happens? Well, when you come to the bank to get your money, I don't have the money to give you. Okay. Now, there's something called FDIC insurance, which used to be $100,000. They raised it to $250,000 as a result of all this 2008 stuff. So if that actually happened, and by the way, I'd probably spend the rest of my life in prison if I did that, but if that actually happened, then your deposits are covered under FDIC insurance up to $250,000. But who is the one paying for the insurance? Yeah, it's the Federal Deposit Insurance Corporation, or what, FDIC, Federal Deposit Insurance Corporation, I guess it is. That's taxpayer money. That's taxpayer money. So if that actually happened, then really at the end of the day, what would happen is the taxpayers are the ones that are bailing me out. Okay, and that's another part of what this is aimed at. When I was getting back up to speed on some of this stuff, they was talking about regulating banks' investments in hedge funds and derivatives, and I didn't know they could do that stuff in the first place. All right, go talk to Professor Smith about all that. He's our resident expert on that kind of stuff. But I didn't know they could do that kind of stuff in the first place. But they've curtailed the types of derivatives. I would imagine the only derivatives tradings they could do would be hedging, but I don't know, I didn't know they could do any at all. Okay, so that, and also one other thing this did that I've been meaning to look at is it provides credit rating, a credit rating system. That was another issue in the 2008 stuff, is there are three credit rating agencies: Moody's, Standard & Poor's, and Fitch, I believe, are the three credit agencies. And their job in life is to assess, and it's primarily bonds, but other things as well, is to assess the credit worthiness of these instruments on behalf of us as decision makers. Okay, so we want to buy bonds in a company, for example. All right, and you know, rather than, and maybe we're not experts on company financial policy or, you know, company financial health. So what we do is we go to these rating agencies and they rate the bonds, okay? And the bonds basically go from AAA down to D rating, where AAA is the best, D would be junk bonds. Okay, and that's how we would make our investing decision. Of course, the returns would be related to that, and so forth and so on. All right. Well, in 2008, what happened unbelievably to me is some of the collateralized debt obligations, what they were called, where what they're doing is they're bundling up a bunch of mortgages. When I say they, I mean on Wall Street, bundling up a bunch of mortgages into one product and then selling those products. Okay, people had no idea what they were buying. Which, by the way, is one of the this is your official investment tip for the day. In fact, for the entire semester. If you don't understand something, don't invest in it. Okay, if you don't understand it, don't invest in it. And, you know, it's easy to sit here and laugh about it, but there was a program on, I think it was on CNBC or maybe the History Channel. I don't remember which it was, but it was something called like a deck of cards or something like that. But they looked at 4 entities that failed as a result of all this stuff back in 2008. One of them, I had to feel sorry for the lady, even though she kind of deserved what she got, but I had to feel sorry for her because she seemed like a nice lady. But she was the mayor, I believe it was, of a town over in Norway. And, you know, she had the town's money and she was trying to invest that money wisely for the town and ended up investing in one of these, I believe she invested in a collateralized debt obligation, and she had no idea how it worked. Okay, but she invested in it based on these ratings, and the ratings gave this instrument a very high rating, meaning they said that there was low risk in this investment when it was the exact opposite. And I think this poor lady ended up bankrupting her, you know, little village over in Norway. And like I say, I mean, kind of in a way, she deserved what she got, but she actually seemed like a nice lady, and I kind of felt sorry for her a little bit. But so part of the Dodd-Frank is they've also come out with ratings themselves, which I like. Well, the intention is that they would be a little more accurate than some of the other ratings that have been around. But that's kind of a whole. I guess we could do a whole another class just on that. All right. But yeah, I want to emphasize on that. This is an accounting class, but you guys are decision makers. So when you're making your decisions on what to invest in, if you don't understand it, don't invest in it. That's actually part of the point of this course, is so you can understand financial statements better. All right. Okay, so all of that in the Dodd-Frank Act, all of that was aimed at financial institutions. Okay, they also had some provisions in there that were aimed at the consumers, at us as consumers. One was to curb the practice of predatory lending. Okay, what's called predatory lending. And that one, I believe, because back in 2006, I bought a piece of property, and when I was going through the financing options on that property, just the financing options that I was interested in, okay, there were whole baskets of options that were off the table. I wasn't even interested in talking about it. Just of the ones that I was interested in talking about, I think I analyzed like 27 different financing options for this property. And the only reason that I stopped at 27 was because I got tired. I got tired of looking at it all, okay? And I stopped there. I could have gone on and on and on. And at the risk of sounding arrogant, I don't mean it that way, but the reality of the matter is that the reason I went through all this is because I'm interested in it. And I know more than the average person about financing, so I was digging into it to find out what was going on. And like I say, I stopped at 27 and kind of had to make a decision from there. You know, so if someone who has sophisticated financial knowledge has that much trouble trying to figure out the terms of the loan that they're trying to get, what chance does someone who really doesn't have any finance training have in something like that? Okay, what's that?
Zero chance.
Yeah, zero. Yeah. Yeah, her question is, don't they do that on purpose? Well, let me.
As you throw in there, one of the big problems with the financial crisis, though, was no money down, no income verification,
Yeah.
adjustable rate. People were, speculating property, thinking they're going to make $3 million off of it.
Yeah.
When it came time to pay, no one, they couldn't pay, they couldn't flip the house, foreclosure. That's where those securities crashed and they were traded in the global financial crisis.
Yep, I agree. Okay. What did you just say? Oh, no, yeah, because what she was saying don't they do this on purpose? Well, let me put a little spin on that, and it's contract. It's contract negotiation. So if you're entering into a contract with someone, how do you want the terms of that contract to be written?
In your favor.
In your favor. I mean, that's business. That's business. In fact, somebody I know, one of my friends right now, very nice lady, who's all uptight. She's trying to sell a house, and the buyer of the house is just wanting everything under the sun, and she's all upset about that because she's taking it personally. It's not personal. It's just business. They're trying to get everything that, you're trying to get the maximum sales price you can. They're trying to pay the minimum they can. I mean, that's just, but she's all uptight about it. It's kind of funny, but I feel for her anyhow. So yeah, you could say they're trying to trick you, but they're trying to get the best deal they can. The point being that part of the Dodd-Frank Act is intended to help us as consumers, or help them as consumers, because you guys are more financially sophisticated than most, help them as consumers not get caught in loans that they don't understand. Because it also increases, I think you mentioned this, it increases some of the disclosures in the loans. I haven't really kept up with the process, but the last time I had this conversation, which was several years ago, my understanding was that the lending procedures, it was getting back to more the way it was like 30 years ago. Which means that, if you couldn't qualify for a standard 30-year mortgage, then you couldn't qualify for the other more sophisticated things. Because see, that was the problem. That was the problem is, you couldn't qualify for a 30-year mortgage because the payment was too high. Pay attention, because the payment was too high, but that's okay because we can still get you into that house under one of these other financing options. Okay, so if you do one of these other financing options, then your payments are lower, so you can afford them, okay? Well, yeah, the payments do go higher later on down the road, but by then you'll have, a promotion or this or that or the other thing, and that's what they get you into, and then guess what happens?
That was the idea of...
You don't get the promotion. You don't get the promotion, okay? So, yeah, there's lots of examples of that. So.
Also, back to what you were saying earlier about the regulation of the banking industry. In response to the Great Depression, they crafted a number of the specific legislation separating investment banking from commercial banking. Then it was, I think, in the 70s, repealed.
Okay.
I remember you mentioned that.
Yep. Thank you. Got it. Okay. So that was Dodd-Frank. All right, that's my summary. Like I said, I honestly don't pretend to be an expert on Dodd-Frank, but that's like the big picture of it. So be aware of that. Also, the other one is Sarbanes-Oxley. Okay, this is more affectionately referred to as SOX. And this is actually more directly related to accounting. Dodd-Frank was aimed, like I said, more at the financial institutions. The Sarbanes-Oxley Act was aimed at the accounting rules. So this is where Kelsey and Kelly and Zhao and all of them were going to make some little extra money because, among a whole bunch of other things, it imposed a lot of rules on internal controls within a company. So there's a whole bunch of accounting things going on with Sarbanes-Oxley. But here's the problem, or here's the story with Sarbanes-Oxley. One of many things that happened was, and I'm sure you've at least heard of a company called Enron. Enron, okay, they saw, I believe, natural gas, I think was their game. And they were audited. Their auditors was a firm called Arthur Andersen, okay, which is now no longer because of this. All right. So the gist of what was going on here was that Arthur Andersen were the auditors of Enron. Okay, so us as decision makers, you know, if we were interested in investing in Enron, among other things, what we're going to do is we're going to pull Enron's financial statements, go through them, see if they have any of the stuff that we've been talking about all semester in and all that kind of thing. All right, but going back to day one of this course, how do we know that Enron's financial statements purport what they represent to purport? Okay, well, because Arthur Andersen, the supposed third-party auditor, has gone in and looked and said that they're good to go. We'll see not theirs, but we'll see an audit report here after a little while on that. Okay, so what Enron was doing, which nobody knew at the time, was they had a whole bunch of what are called special purpose entities. And these entities are created for special purposes, okay? For special projects. All right, so, and I don't remember the details of the ones for Enron, but they might create a special purpose entity for the purpose of, you know, doing this project within natural gas, that one, or so forth and so on. And what Enron was doing was there was, within these SPEs, there was a whole bunch of debt. All right, so they were using these SPEs to finance projects, and I believe they were selling them back to Enron. Don't quote me on that part, but they were using the SPEs to finance the project, so there was a whole bunch of debt in those SPEs, but because of rule, I think it was 46, I don't remember the exact rule, but as you know, okay, in fact, final exam review, actually it might be this exam review as well, these special purpose entities, generally speaking, Enron owned those entities. Therefore, what should happen?
Should be reported on their balance sheet.
Yeah, give someone else a chance. What should happen? Okay, final exam review. Okay, again, Enron owns all of these entities. Therefore, in terms of financial reporting, what should happen? Darla.
Yeah, it should be part of their balance sheet.
Yeah, okay, that's the consolidated financial statements. So these entities should be consolidated into Enron's broader financial statements, including the debt. Okay? Well, what they did was they took advantage of some accounting rules, and it was something like they only owned 49% of the SPEs, and then the other 51% was owned, I think, by like the individuals in Enron, something like that. I don't remember the details, but it was something like that. So they got around the consolidation rules. The upshot of it, the result of that, was there was all this debt out there that was not being reported on Enron's financial statements. Therefore, what's the effect on their results? Assets, way up here. Debt, way understated. Therefore, when you start calculating your debt ratio, your debt to equity ratio, return on assets, return on equity, all of that stuff is inflated because they had massive amounts of debts that weren't even on their financial statements. Okay? Now, I'm sorry? Well, it was all that was being paid through the SPEs. Okay? All right. So, what's that?
Did anyone go to the President
I believe that. Yeah, I believe some of the execs did go to prison. I don't remember. But it was all that was being financed through the SPEs. Okay. Now here's the thing: Arthur Andersen was supposed to catch that kind of. Well, it's hard to imagine because remember, auditors are not responsible for finding fraud. Okay. But if it comes to their attention, then they're required to follow it. Okay, so the question came up with this massive amount of debt going on, why didn't Arthur Andersen catch it? Okay? Well, there was another element to that, which was, sorry about that, that says consulting. Okay? If you take the pen off the screen just a little bit, it'll still write. Unlike a whiteboard, so sorry about that. That says consulting. Okay. One of the additional problems was that Arthur Andersen, in addition to being an auditor of Enron, was also a business consultant of Enron. And that became a potential issue because auditors are supposed to be financially independent of the companies that they're auditing. But if I remember correctly, their consulting fees were actually higher than their audit fees. It's actually higher than their audit fees. So then the question came up, well, wait a minute. Okay. Did they not know, did Arthur Andersen not know about this, or did they really know about it, but they just didn't bring it to the board's attention or didn't express proper concerns about it to the board because Enron is a big fish for Arthur Andersen in terms of their revenue. Okay. So, all right, last question of the morning. What can I help you with?
The question for you is, of course it's unethical, but was that also illegal at the time?
Yeah. It was illegal if they knew about it.
Well, I'm saying,
And that's the whole point is,
Fort Sox, is it illegal
Yes.
to consult?
no, it's not, no. It's not illegal to be a consultant, okay? But that's the rub in there, okay? And that's a good question. That's the rub in there. It's not illegal in fact, that's common practice in public accounting for them to be a consultant, but as an auditor, they're supposed to be financially independent. So one of the things that is highlighted was, can you really do both? Can you really do both and still fulfill your obligation as the auditor, okay? And Arthur Andersen kind of broke into two as a result of that, yeah. Well, you're right. But the issue here was this was so big. How did the auditors not know about it? I mean, how did they not run across something in the files referring to one of these special purpose entities and not follow it? And that was actually the issue because the implication, at least, was that, well, Arthur Andersen, who's getting a lot more in consulting fees than they are in auditing fees, it's not in their best interest to do so. To heck with the investing public, it's not in their best interest to do so. Therefore, they and kind of looked the other way on it or didn't bring it to people's attention. And that's and the problem with this was that once all of this came to light, then everybody started questioning, and Arthur Andersen, by the way, was one of the big 5 accounting firms at the time. They were one of the 5 largest in the country, one of the best reputations. When you had an Arthur Andersen stamp on your audit, you were good to go. Well, if they're that trustworthy and they're doing this, then how do we have any confidence in any of the other auditors out there? And therefore, how do we have any other confidence in the other financial statements out there? And that became the issue. And if the entire investing public is going to start questioning all of the financial statements, then exchanges no longer take place. Remember we had that conversation? Exchanges no longer take place, and the whole economy suffers as a result. Okay? To prevent that, Sarbanes-Oxley was passed. Now, by the way, not really the end of the story, but one of the ends of Arthur Andersen was Arthur Andersen was actually ultimately convicted of obstruction of justice, because when all this came to light and they learned that, I guess it would be the feds or whoever it was going to come out to their offices and pay them a visit and start looking at they were staying up till all hours of the night shredding documents. And they were convinced that was the end of Arthur Andersen. But their consulting business survived, and it is now called, it starts with an A. The name of it escapes me. The consulting side survived. Remember you seeing the commercials years ago for Andersen Consulting? That's what this was. Okay. So anyhow, so the Sarbanes-Oxley Act, what it did was it came in and, like I say, it imposed a whole bunch of internal controls and all this kind of stuff. But the upshot of the Sarbanes-Oxley Act was it made the managers of the company responsible for their financial statements, for the financial statements of the company. All right? Now, the problem with that, and I think I mentioned this before when we talked about this earlier in the semester, and I've talked to people who know a lot more about SOX than I do, and they've all agreed with me. Okay? The problem with that is that for those who know, like BDO, Kelly's watching that, for those who know, she's starting at BDO, so that's the commercial I tease her about all the time. For those who know, management has always been responsible for their financial statements. They've always been responsible. I mean, I think there's been a little more formality in terms of, management has to sign this, they got to sign, I think there's been a little more formality of it. But, they're passing the Sarbanes-Oxley saying, hey, okay, you can now start investing again because we're making managers responsible for their own financial statements. But they've always been responsible for them. I remember that back when I was in Kelsey's stage of the game way back in the 80s, studying all that stuff. Okay, so that is the Sarbanes-Oxley Act. Okay, and that was actually prior to 2008. That went back to 2002. But make sure you're familiar with both of those pieces of legislation, SOX and Dodd-Frank. Okay, at least what I've given you is kind of the big picture overall purpose of them, which is something that you should at least be familiar with. If you take your banking classes, I'm sure you'll get into Dodd-Frank a lot more in there, and you guys won't be taking auditing, so I don't know that you'll get into SOX too much more, but you may see it in some other classes. So, okay, all right. Questions about any of that? Questions about any of that? Let me catch up on my notes and see where I am. Questions? Okay. So now let's get into some. We're talking about. I love the word they use here, shenanigans. Okay, we're talking about financial shenanigans going on here. So let's take a closer look at some of this. They give you a whole list of potential misrepresentations on the financial statements, and we actually talked about some of these last time. All right, and this is actually a good list, and I'm going to try not to get bogged down and go through all the details of this. But there's some good information in here, and as you go through this, as you're studying for the exam, and more importantly for your own financial knowledge, keep in mind one way, or I guess multiple ways really, but in particular, one way you might find this stuff, okay, you as decision makers, okay, one way you might find this, and that is through an analysis, or at least a cursory analysis of earnings quality, which we talked about last time. And how do we look at that? Earnings quality. There was one measure that we looked at quite a bit, guaranteed on the exam. No secret. Guaranteed on the exam. Yeah. Nah, that was close. Operating cash flow. You almost had me writing down OCI. Net income minus operating cash flow, divided by average total assets. And like I said last time, dividing by average total assets is just to scale things, okay? So if you're comparing companies of different sizes, okay, it's just to scale. So really the meat of this is the difference between net income and operating cash flow. Okay, that's really the meat of this. So as you're going through these, okay, keep in mind how that would affect our earnings quality measure. Okay, so what do we got on the first? Like I said, I'm going to try not to get bogged down in the details of all of these, but there's some interesting details in here. And this is, by the way, on earnings. The next slide is cash flow. Okay, so this is looking at how earnings might be manipulated. And by the way, the manipulation of earnings, and more specifically net income, is generally referred to as earnings management. I was thinking income smoothing, which are synonymous terms. Okay, so final exam review, earnings management. Yeah. Earnings quality. Earnings quality. This is for earnings quality. Okay. Yeah. Yeah, earnings management is more of a broad and I think more of a descriptive term. Income smoothing is really a technique or a goal within earnings management. But the gist of all of that is, you know that earnings are supposed to, let me make it more broad than that. Financial statements are supposed to most properly reflect underlying economic reality. Okay, so to the extent that a company takes accounting rules and does these kinds of things, then they're masking the underlying economic reality. And therefore, us as decision makers, as investors, we're not investing in what we think we're investing in. Okay, the extreme example of that, which is clearly illegal and fraud, is Enron, like what we're just talking about. You know, you think you're investing in a company with this risk profile, and you don't know that they have millions, or I don't know how much debt they had, but millions, if not billions of dollars in debt in all these entities you don't even know about.
And that doesn't fall under GAAP standards, right?
Well, whether or not it falls under GAAP standards depends on what's going on. Sometimes what they do, and I think really earnings management usually refers to taking the gray areas of GAAP and using them to your advantage. I would say that, as opposed to fraud. I mean, if they're doing something that's illegal, that's just simple, that's fraudulent. And some of these things on here are fraudulent. Okay, but I think it would be fair to say that usually when we talk about earnings management, we're talking about taking the GAAP rules and using them not for the purpose of transparency, but for the purpose of making earnings look better than they really are. That make sense? Yeah. I'm glad I recorded that. I like the way I said that. Okay. All right. So let's see. Okay, recording revenue before completing any contracts under the contract. Okay, and this is actually common, not this procedure, but in the construction industry. I'd mentioned this once before. One of the ways that you're working on a building and it might take 3 years to finish the building. Well, you're going to recognize revenue along the way, and one of the ways is percentage completion contract accounting, which we don't get into here, but they get into it quite a bit in their accounting classes. And the upshot of it is that if you have a building contract, and let's say at the end of the year you're 30% complete with the building, then you recognize 30% of your revenue this year, and 30% of the costs. Okay, I mean, that's the upshot of it. Well, what happens if, our earnings are kind of down, so now let's go ahead and recognize 31% or 32% or 35%, even though we're not that far along. Okay? Well, you're moving revenue, it's a timing issue. You're moving revenue into this period when it really belongs into future periods. And that's related to what we talked about last time, because what's going to be the effect on our measure here? Okay? Well, net income is going to go up, but cash flow, we won't have a corresponding increase in the cash flow unless the client is dumb enough to believe us. Okay? But even then, it would still unwind in future periods. So it's the same thing like what we talked about last time, or the same effect. Okay? Recording revenue far in excess of work completed on the contract. Okay, same idea. Recording revenue before the buyer's final acceptance of the product. Okay, so I sell you something, but before you have a chance to inspect it and formally take delivery of it, I go ahead and record revenue. Okay, well, again, net income going up, but you haven't paid me squat because you haven't inspected it yet. Okay, so again, that's increasing that difference. Remember last time we talked about income increasing accruals versus income decreasing accruals. So the larger that ratio, the more questionable the earnings quality. Okay, and that's an important phrase. That doesn't necessarily mean because that is high, the earnings are not accurate. That's not what that's saying. It's just saying if that's high, there are more accruals in there, therefore there's more of an opportunity. You know, I think about that when I drive down Lockwood. If any of you drive down Lockwood, it's a great road to, I shouldn't say it because now you'll drive it and get in my way, but it's a great road to drive because there's no stop signs and no stop lights, and you can just cruise, okay? So the opportunity to speed is much higher. That doesn't mean you're doing it. It doesn't mean people are doing it, which they are, but it doesn't mean that. It just means the opportunity is there, okay? Let's see, and then recording buyer's payment remains uncertain and necessary. Recording bogus revenue, I think this would get back to, I think that this would kind of get into the fraud area a little bit here. Transactions that lack economic substance, I don't know. I can't give you a good example of that off the top of my head. Recording revenue from transactions that lack a reasonable arm's length process. What does that phrase mean? That's something you guys should be familiar with. What does it mean to be at arm's length? And I don't know that there's a real crisp definition for this, but you should at least have a feel for what it means.
I guess that's in front of you.
I'm sorry, that's what?
It's within your reach, or like in front of you, it's about to happen, it's about to be realized.
In front of you, yes, good opening comment. Don't have much influence. Okay. Yeah, I think that's getting a little closer. Anybody else? Go ahead. Whether it's reasonable, I think that would be a part of it, yeah. Yeah. Okay. Being at arm's length means that you really don't have a financial interest in it, okay? The auditor, Arthur Andersen and Enron, Arthur Andersen is supposed to be at arm's length, really any auditor, is supposed to be at arm's length from the company, meaning they really don't have a financial interest in its success or failure. So if the company's successful, they're not going to really benefit that much from it, or if the company fails, they're not going to be taken down with it, okay? So like I said, I don't know that there's really a crisp definition for arm's length, but that's what it means to be at arm's length from something, you know. Okay. All right, recording on receipts, non-revenue producing, appropriate transaction at inflated amounts. Okay, and then get one-time events. We've talked about this already, things just extraordinary items and so forth, so we've done that. And then shifting expenses, improperly capitalizing normal operating expenses. Final exam review, what does it mean to capitalize something? Final, almost guaranteed on the final exam.
Either extends the life of equipment or like you can make more revenue out of it.
You can make more revenue, help them out.
To record expense as an asset.
Outstanding. To record a cash outflow or a cost as an asset instead of an expense. So if you improperly record, thinking it through, if you improperly record something as an asset instead of an expense, what happens to earnings? They're overstated. For that matter, what happens to assets? They're also overstated. So the book value of the company is overstated, and the earnings of the company is overstated. Okay? And they didn't receive, and they without a corresponding cash flow. So again, we'd have a difference here. Okay, amortizing costs too slowly. All right, failing to write down as. Okay, this is one that we didn't talk about too much in here, I don't believe, but something that you should be aware of. I'm not going to get bogged down into the details of all this. My accounting major TAs can talk to you about this if you'd like to talk about it more. But be aware that under GAAP rules, that assets, okay, if assets, or I guess actually we did talk about this a little bit, if they're impaired, then there's a possibility that you might have to write the asset down. And we did talk about this because I remember using the hurricane example before. We talked about insurance and all that kind of stuff. All right, but you have a big factory, okay? Hurricane comes blowing through here and part of the factory gets destroyed. All right, well, the value of that factory, that asset, has now decreased. Okay, so companies, if that asset's impaired, then under the conservative principle, they're required to write down the value of that asset and therefore take a loss on it. Therefore, earnings go down and assets go down. Therefore, book value goes down. Okay, well, who wants to do that? Okay, nobody, especially if your earnings are already suffering this year. Okay, so be aware of that, and devalued investments, yeah.
To repair, like, fix a building or something, would you capitalize that or expense it? Because you're increasing it as an asset.
Well, and that's a good question, which we had talked about, but it's a good final exam review because her question was, if you repair, tricky wording, if you repair a building, do you capitalize it or do you expense it? And final exam review, what's our rule? Somebody just mentioned this a minute ago. What's our rule for capitalizing?
If it adds like extreme value to the asset, if it
Okay.
of it, then it'll like be capitalized. If it doesn't,
I'm sorry, if it increases what?
the value of the
Okay. If it significantly increases the value of the asset, or,
I was gonna say if it's like maintenance, like you repaint the door, that.
yeah, that's true. That's true. But the question is, how do we distinguish between repairs and maintenance and capitalized items? So one of them is if the value is significantly increased. You had a chance. Yeah. I'm trying to spread it around as best I can. What's that? Yeah, that's an example. Bail us out.
What is it? Extends the useful life?
Outstanding. If it extends the useful life of the asset. Okay, final exam review. All right. So that's a standard issue. That's a standard issue. We're spending this money on this building. Should we expense it or should we capitalize it? Okay. There's our criteria for making that decision. Now, like we talked about before, I don't want to get bogged down into this again, but like we talked about before, the issue is that we have conflicting incentives because for tax purposes, we want to expense it. Well, we want to expense it to lower taxable income. But for financial statement reporting purposes, we want to capitalize it. Okay? And like we talked about back then, it's not always clear what should be done. Okay? All right, so that was all aimed at earnings. These are all cash flow shenanigans. And I think most of these boil down to misclassification of cash flows on the statement of cash flow. Okay? So, and some of them are actually kind of funny. Like the first one, recording bogus cash flows from operations from a normal bank borrowing. Okay? So in other words, you borrow money from a bank and report it as an operating cash inflow. That one's pretty obvious. Okay. Something else I wanted to point out to you. They say boosted cash flows from operations by selling receivables before the collection date. Okay. Be aware that it is common practice. I mean, I'm not saying all companies do it a lot, but it is certainly well known that it's done. That companies, if they're in a cash crunch, might sell their receivables. Okay, so let's say you're running a company, you have $10,000 in accounts receivable, but you need money right now. You need money right now to make payroll. Okay, well, what I might offer to do is to come in and buy those receivables from you at a slightly less than face value of $10,000. Okay, so I might buy, I don't know what a fair price would be, but let's say $9,000. Okay, so the benefit to you is you don't have to wait on your deadbeat customers to pay your payables. You get the $9,000 right now to make payroll. Okay, but there's always a trade-off. Okay, and the trade-off is you're not getting full face value. Okay, but you're shifting the risk to me. Okay, so now I'm the one that's responsible for going out and getting the $10,000 receivables. So if they don't pay, it's my problem, not your problem, depending on the exact arrangement. Okay? Oh my gosh. Yeah.
So in that case, who would the customers typically be paying to? Would they be paying to the original company or
That's a good question, and that's a legal question. And I believe the customers would be paying to me because I would be sending out notices kind of like with a mortgage, because it's different situation, but common in mortgages for mortgage companies to sell the loans, and then all of a sudden you get a book in the mail saying, hey, you no longer pay Bank of America, now you're paying Wells Fargo. That's pretty common. So I think they would pay me directly. That might depend on the arrangement a little bit, though. That's a good question, though. Yep.
Back to that example, would that accounts receivable account be sold as a bond?
I'm sorry, wouldn't it be sold as a what?
As a bond? So like if I wanted to buy that debt?
Well, no, it wouldn't be sold as a bond, but the point of this right here is that when you do that, is that really an operating cash flow? And it's really no, it's more of a financing cash flow. So that cash inflow shouldn't be included in part of your operations. It should be included in the financing section. And by the way, this whole section right here is all shifting cash from the financing section to the operating section. Okay? Okay. And the next one, which is related, is faking the sale of receivables. Okay? And I guess that would be where we did what I just said, except there's one additional criteria. And that is that if I can't collect it, then I give it back to you. So now you're still stuck with it. So in that case, have you really sold them at all? No. No, you haven't sold them at all. Okay. So, and the more, now I think like a collection agency. So you'd pay the collection agency. Okay. So forth and so on. I'll pick up some speed here. Let me see if I talked about capitalizing already. Boomerang transactions. This last section down here is really about timing. So I'm going to bypass the rest of the details on this for the sake of time. But these tables that are in your book, go through the details of this because this is kind of a good preliminary summary of the course. Okay, as decision makers, you're looking at financial statements. Well, what are you looking out for? Well, maybe the financial statements don't represent underlying economic reality because of, and here's a whole list of examples of why they may not. All right, and the effect, I showed you something similar. Last time, but I put the spreadsheet together quite a while ago just to kind of illustrate the potential here. All right, so what I've got is just a very basic example of what an income statement, for example, should be versus what it might be if they made small manipulations all the way down the statement. Okay, and one of the things that's important in here, even though you guys aren't going to be auditors, it's important for you to at least have a feel of the audit process. And one of the key red flags in the audit process, and I used to be an auditor for a little while, is you look at the difference between last year and this year. Okay, because if you audited last year's financial statements and they were good to go last year, and then you're looking at them again this year, and this year they're pretty, whatever this item is that you're looking at, it's pretty much the same as last year, then, nothing jumps out at you. Okay, but it's never going to be exactly the same. It's never going to be exactly the same. Okay, but if it's within reason, then okay. Well, let's say that you do that all the way down the financial statements by bumping things just 0.25%. And that's not going to really catch anybody's attention. 0.25%. The general rule of thumb is 1%. Okay, so if something's greater than 1%, that's when you kind of red flags kind of start going up a little bit. If it's less than that, not really. It kind of depends on the issue. But let's say that you bumped up revenue by 0.25%, bumped down cost of goods sold by 0.25%, so forth and so on, all the way down the income statement. So for each individual line item, everything pretty much lines up with last year, but at the end of the day, what happens to earnings? They all add up, and you've got a 4.5% increase in earnings, which is a huge increase. So you wouldn't even have to do all of this. If you could bump this up, 1% or so, then that would certainly drive your stock price up a little bit. Okay. What was I going to say? Add up. Yeah, I got that. Oh, yeah. And this is just illustrating the potential. Okay. And this should be caught by the auditors, even if it's not, because it should be caught by the auditors before it leaves the office, but whether it is or not is another story. Okay. No. Okay. Questions about that? I had no idea it was going to take us this long, because that's just like the first half of chapter 2, and I had no idea it was going to take us this long. But good discussion. So this is probably a good place to stop and talk about the exam a little bit. So other than exam, questions. Other than exam, questions. Okay, you guys want to do this on the exam? Okay. So since you don't want to do it, then we won't do it. So no, I'm just kidding. Now what I did, chapter 10, I'm going to bump that into the final exam. So the third exam is just going to be on chapters 8 and 9, and I couldn't tell you that at the beginning of class because then nobody pays attention. So I can't say that at the beginning of class. Everything I do for a reason. Everything I do, and that reason always has your best interest at heart. Okay, so chapter 8 and 9, let me see. Yeah. So we're going to focus on just chapters 8 and 9, and that is fine by me because chapters 8 and 9 are very, very important in this course. In fact, I'm kind of thinking, and I haven't made a decision yet, so we'll talk about this later on, but on the final exam, which is cumulative, even though it's cumulative, I may weight it a little more heavily on chapters 8 and 9. So I want you to know these chapters really well. Okay, chapter 8, of course, is on the equity section. Like I told you back then, a lot of people who don't have a lot of financial statement training don't understand the equity section. Okay, so make sure you go through every detail of the equity section. Okay, and we went all down it. Preferred stock, common stock, APIC, retained earnings, treasury stock, other comprehensive income. I think that was it. Okay, so make sure you go through all of the details of the equity section. All right. Chapter 9 was on the income statement. Okay, so we went through the line items on the income statement. Make sure you understand that calculating operating income is a very important calculation. Okay, because of course that captures the operations of the business. Okay, what's below it doesn't. All right, so the operating income is arguably a better measure of the company's financial health than net income. Okay, so we talked about that. And then the second half of chapter 9 was on statement of cash flow. Okay, so make sure you go through the details of the statement of cash flow because, again, a lot of people don't really understand the statement of cash flow. It's a very informative statement. We were just looking at as an example of it here going through the earnings shenanigans. Okay, so make sure you can calculate cash flow from operations, cash flow from investing, cash flow from financing, because that, with respect to the statement of cash flow, in my opinion, the best way to really understand the statement is to know how it's prepared. Okay, so this isn't an accounting class. You guys aren't going to be preparing the statement of cash flow out there, but who do you want to come fix your house? Someone who knows how to build it or someone who just knows how to go out there and stick bubble gum on it? Okay, you want someone who knows how to actually build the house. All right, so with respect to the statement of cash flow and all of them, because I won't be, I can't ask you to prepare the income statement or the statement of cash flow, but I can and will ask you, calculate gross profit, calculate operating income, calculate net income, and then, your various cash flows and so forth and so on. Okay, so this exam is just on 2 chapters, a great opportunity to give yourself some breathing room going into the final. Okay, a great opportunity to do that. Plus, and frankly, more importantly than that, the equity section and the statement of cash flow are one of the main focuses of this course. Okay, and there were some questions. Yeah.
With the other comprehensive income, how you explain it, how the book explains it is completely different because the book says that it's not.
Okay. What he's saying is that the way I explained the other comprehensive income was different than the book's way. Well, we're both right. Okay, so if you can understand it both ways, then you're good to go. Okay? If you can't, then you probably don't understand it quite as well as you think you do. Now, especially with the statement of cash flow, I mean, I went further in the statement of cash flow than the book did as well. I might have with OCI, I really don't remember off the top of my head. So, I mean, I might have expanded beyond what the book said. But, I mean, we're both saying the same thing. I think if we're not, if you think we're not, let us know. I mean, and that's a sincere comment. If you think we're not, let us know. But as far as I know, we're both saying the same thing. Other questions? I saw a few more hands. Yeah. Oh, okay. That's a good question. Yeah. In fact, I was going to show you some financial statements on here, and I ran out of time. But I was going to show you JetBlue and point out their basic versus diluted earnings per share. What's the difference? First of all, how do you calculate earnings per share? Net income divided by average shares outstanding. Okay, the weighted average shares outstanding. So that means you got to know how to calculate weighted average shares outstanding. So to calculate earnings per share, you got to know how to calculate weighted average shares outstanding, which gives you your weighted average earnings per share. So you got to know how to calculate that. Okay. Now that you know how to calculate that, what's the difference between basic and diluted earnings per share? Yeah.
Think about the shares that are preferred as well, and if
No, these are common shares.
okay,
Common shares.
wasn't it in reference to the options that people had to use
Yeah.
if they exercised those options?
And what is the reference? Yes, it has to do with options.
Stock options buy the stock at a different price, so kind of.
Well, it's not really about the price.
It's the other way. If we want to buy more stock from the company must sell more stock.
That's a true statement. So, but what's the difference? Let's say basic earnings per share is $1.30 and diluted is $1.25. What's the difference? Bail us out. Why?
Because people bought into their.
Okay. Yeah. Basic earnings per share is just the earnings per share calculated based on the current share, the weighted average, current shares outstanding. Okay? But they may very well have these derivative instruments that allow stakeholders at their discretion to buy more shares, in which case the company has to issue those shares. Okay? The company doesn't know whether or not they're going to do it, okay, because it's at their discretion. All right? But if they do it, then there will be more shares outstanding, and therefore earnings per share will go down. Okay? So the basic is based on weighted average shares that are currently outstanding. The diluted is the earnings per share if everybody bought all these shares that are sitting out there. Okay? So I guess you could kind of look at it, and this is just a very loose way of saying it, I guess you could look at it as the current situation and the worst case scenario. That's just to help you understand it, yeah.
Just so I can make sure that I understand what you're saying, diluted is if every share that's issued is purchased, what it would be?
No. Simple example. Let's say that right now there are 1,000 shares outstanding. Okay? And let's say earnings are $100. Okay? So earnings per share is 10 cents a share. Okay? But let's say that you own an option contract to buy, to buy 50 shares. Okay? Those shares are not outstanding. Okay? Only 1,000 shares are outstanding. So the company's current earnings per share is 10 cents a share. Okay? But if you exercised your right to buy those additional 50 shares, then shares outstanding would be 1,050. So then you would have this. Okay. So this is basic earnings per share, and this is diluted because you're exercising your right, and therefore you're diluting the earnings per share. That's where the name comes from. Okay, does that make sense? Okay. That was apparently that was a very good question. Other questions? Other questions? Okay, what was it? So chapter 8, chapter 9, earnings fully and all that kind of stuff. So other questions? Going once, twice? Stock splits. Stock splits are easy.
I wanted to ask you whether it says figuring out, what would make it the same. I remember you were talking about it was on chapter 8 homework. What would the value be to make it the same value?
I'm not sure about that, but stock splits are easy. Thousand shares outstanding. I don't know. Price is $30 a share. I get crazy with you on the exam, and I say the company has a 13 for 11 stock split. 13 for 11 stock split. Oh my gosh, I can't believe it. He's trying to fail us in this class. He's so mean. What a winner he is, It's so simple. It's so simple. What do you do? 1,000 shares outstanding times 1311. The value, regardless of whether it's the par value or the market value. Okay, so it's going to be the same either way. Par value, 13. Okay, and the key is that before and after the split, the value has to be the same. Okay, so that's why, because when we covered it in at least the PowerPoint slides from the publisher, they made it seem a little harder than it really is. It's actually very easy. Now, keep in mind, what we're talking about here is as a result of the mechanics of the stock split. Okay, what they're hoping is that the market will like the stock split, and therefore demand for the stock will go up, and therefore the stock price will go up. That's what they're hoping, but that's after the stock split. That's the reaction to the stock split, not the stock split itself. Okay? All right, one more, yeah.
What's the question, 13 to 11?
I'm sorry?
What's the question?
Yeah, 13 for 11. 13 for 11 stock split, yeah. So, all right, there you go. The TAs will be in until about 4 o'clock today if you have any questions. Good luck on the exam. It's only 2 chapters. Go get a good grade on the exam. Give yourself some breathing room going into the final. Good luck. Have a good Veterans Day. I'll see you guys on Tuesday. Can you hang on one second?